As the U.S. stock market closed for the week on Friday, October 31st, 2025, shares of Opendoor Technologies, ticker OPEN, finished a spectacularly strong session. The stock closed at $7.77 per share. That marks a gain of 5.86% on the day, a move that was powered by absolutely massive trading volume of over 120 million shares, far eclipsing its daily average. This strong finish caps off what has been a truly astonishing run for the stock in 2025, with shares up over 380% since the beginning of the year, catapulting it from a low of nearly 50 cents to its current levels. It's a performance that has captured the attention of the entire market, creating a powerful narrative that Opendoor is the definitive recovery play for the real estate sector. But the most jarring piece of data, the one that's almost never mentioned in the same breath as that 380% gain, is what Wall Street analysts think it's actually worth. The consensus analyst price target on Opendoor isn't $10 or $12 or even its current $7.77. The average price target from the firms covering the stock is a shocking $1.87. That isn't a prediction of a slowdown. It's a forecast of a catastrophic collapse, implying a more than 77% drop from where it just closed. This is the central conflict, the massive disconnect at the heart of Opendoor. How can a stock be up nearly 400% while the professionals who analyze it for a living believe it's worth 77% less? This is the expectation versus reality gap that defines this company. The expectation, the story that has propelled this stock, is straightforward. A cooler-than-expected inflation report just last week sent the stock soaring over 15% in a single day, fueling the belief that the Federal Reserve is finished hiking rates and that cuts are on the horizon. Lower mortgage rates, the thinking goes, will unclog the frozen housing market, and Opendoor, as the tech-forward iBuyer, will be the primary beneficiary. The company itself is leaning heavily into this retail enthusiasm, just announcing that its upcoming third-quarter earnings report on November 6th will be a financial open house, live-streamed on platforms like Robinhood and X, allowing individual investors to ask questions directly. It's a brilliant move to court the very investors who have championed its stock. But this is where the reality, the one represented by that $1.87 price target, becomes critical to understand. The professional short argument against Opendoor is that the iBuying business model, which involves holding billions in housing inventory, is fundamentally broken in a volatile interest rate environment. They see a company that achieved its first profitable quarter in 2 years last quarter only on an adjusted EBITDA basis, still posting a net loss. They see a business model that requires immense cheap debt to function, and the era of free cost capital is over. This leads us to the most debated topic surrounding Opendoor, the short interest. When you look at the public data, the first number that jumps out is that 22.72% of the company's entire free float is sold short. That is an exceptionally high number. It signifies that a massive structural bet has been placed against the company by hedge funds and institutional players. For many retail investors, a high short interest figure is an immediate signal of a potential short squeeze. But this is where you have to look deeper. The expectation is that this 22.72% figure is a coiled spring waiting to explode. The reality is found in the cost and structure of that short position. The first data point to check is the borrow rate fee. This is the interest rate short sellers must pay to borrow the shares they need to sell. If this rate is high, it can create a cost-to-borrow squeeze, forcing shorts to close their positions. For Opendoor, the borrow rate is currently fluctuating around 0.8%. That is not high. It is incredibly low. It means it is fundamentally cheap and easy for shorts to maintain their negative bet. The second and more important metric is the days to cover. This measures how many days it would take for all short sellers to buy back their shares based on the average daily trading volume. A high days to cover, say 10 days, would mean shorts are trapped. Opendoor's days to cover is approximately 1.4. This low number is a direct result of the stock's massive 120 million share volume on Friday. It means that in aggregate, every single short seller could theoretically cover their entire position in less than 2 trading days. This is not the anatomy of a squeeze. It's the anatomy of a highly liquid, two-sided battleground. What's your take on this? Does the high short interest matter if the borrow cost is low and shorts can cover in a day? Comment below if you think the 22.72% figure is a warning sign for bulls or a setup for a trap. The professional short thesis, held by firms that have issued underperform and sell ratings, isn't just a vague feeling. It's built on the company's balance sheet. The company operates on a high leverage model with a debt-to-equity ratio that is concerning to conservative analysts. They argue that while the company's recent strategic pivot to a more capital-light platform model, partnering with agents and offering products like Cash Plus that give sellers upfront liquidity without Opendoor taking full inventory risk, is a smart move, it may be too little too late. The company has significant debt maturities stacking up between 2026 and 2028, creating a hard timeline by which its finances must improve. They are in a race for time. Can their new, more efficient model start generating real, sustainable profit before their debt load becomes unmanageable? This is why the recent leadership shakeup in September was so significant. The company brought in a new CEO, Kaz Nejatian, the former COO of Shopify, who is described as an AI-native executive. Simultaneously, co-founders Keith Rabois and Eric Yu returned to the board, with Rabois taking the chairman role, bringing what the company called founder DNA back into the leadership. This, combined with a $40 million private equity injection, was a clear signal. The company is refocusing on tech, on AI-driven pricing, and on operational intensity to survive the new, higher-rate environment. For those who are new to the story, Opendoor's business is simple in concept, but incredibly difficult in execution. It is the pioneer of the iBuying model. Instead of a homeowner listing their house with an agent and waiting for a buyer, Opendoor provides a direct, all-cash offer within 24 to 48 hours. The homeowner gets speed and certainty, avoiding showings and repairs. Opendoor takes a service fee, performs light renovations, and then relists the home aiming to sell it for a profit. When mortgage rates were at 3%, this model worked. Opendoor could buy a house, and the market would often rise in the few months it took to flip it, giving them an automatic tailwind. When rates shot up to 7%, that tailwind became a brutal headwind. The value of their inventory dropped, they were forced to sell homes at a loss, and the model's vulnerabilities were laid bare. This is the past that the company is now desperately trying to distance itself from with its new leadership and new platform-focused strategy. So, as an investor, how do you navigate this? The first step is to know where to look for data. The 22.72% short interest figure is public, and you can find it on most major financial data sites. But to get the borrow rate, you often need to check with your broker or use a more specialized service like Fintel or Ortex. To understand the short thesis itself, you have to read the analyst reports, especially from those who have downgraded the stock, like Keith, Brewett, and Woods. You must ask, are they critiquing the company's operations, or are they making a larger macro bet against the entire housing sector? The current retail sentiment you'll find on platforms like Reddit and X is almost entirely focused on the macro. The bull case is simple. Fed cuts rates, housing recovers, Opendoor stock goes to the moon. The new financial open house earnings format is a direct acknowledgement of this shareholder base. They know their stock has been championed by individuals who believe in the long-term disruption of real estate. This brings us to the future outlook. The expectation is that 2026 will be a boom year for housing. The reality, according to many economic forecasts, is more muted. Projections suggest a return to a balanced market, not necessarily a seller's frenzy. Inventory is expected to rise, and prices are forecast to grow at a much more modest pace of 3%, not the double-digit sprints we saw before. For Opendoor, this is the entire ballgame. Can its new AI-driven model accurately price and profit from a 3% growth market? Or does it need a 10% growth market to cover its cost of capital and its massive corporate overhead? The risk is that the market recovery is just strong enough to keep the company afloat, but not strong enough to generate the explosive profit growth that the current $7.77 share price implies. The opportunity is that the new CEO and the returned founders are right, and that their new platform model can detach Opendoor's profitability from the